The broadcast is now starting. All attendees are in listen-only mode.
Hi, good morning, everyone. Thank you all so much for joining us today for our final webinar for 2019, which is on solo 401ks for the self-employed. For those of you joining us for the first time, my name is Amanda Sylvia, and I am the Client Service Associate for Stonehearth. I've been with the firm for almost 5 years now, and I assist with compliance, marketing, and anything client service related. I want to first start off with just a few housekeeping items. On your GoToMeeting taskbar, you should see a section titled Questions. Please feel free to submit your questions throughout the course of the webinar. I will be monitoring all of them, and I'll ask Andrew to answer as many as time allows at the end of the webinar. If we do happen to run low on time and are unable to get to your question, Andrew or myself will reach out to you directly to make sure we do get your question answered. Now I would like to introduce our speaker for today, Andrew Nadeau. Andrew joined our firm in July of this year as a senior financial advisor, bringing with him over 10 years of experience in financial planning and wealth management. Prior to joining us, he most recently spent the past 8 years at Salem 5 Investment Services, the wealth management division of Salem 5 Bank, starting as an investment analyst and transitioning into a financial consultant before serving as the head of financial planning and investment due diligence. He continues to bring his expertise to our firm by conducting portfolio reviews with our clients, co-managing client portfolios, and building, analyzing, and maintaining comprehensive financial plans. Andrew also serves as a member on our firm's investment committee. Andrew, thank you so much for joining us.
Thanks so much for that intro, Amanda, and thank you to everyone for coming out today to learn a little bit about solo 401ks. Solo 401ks are going to be a newer concept for most people and something that gets overshadowed a lot by some of the other small employer retirement plan options that are available. However, solo 401ks can be a tremendous retirement planning vehicle for self-employed individuals. While there are some limitations and drawbacks, which we will explore today, a lot of the benefits may outweigh these depending on your goals and objectives. We will also spend some time today discussing the rules for solo 401ks, who they may be right for, and how to move forward if you think a solo 401k is right for you. Jumping right into the presentation, let's take a look at what solo 401ks are and how they came to be. Simply put, solo 401ks are retirement accounts for self-employed individuals or business owners who have no full-time employees other than a spouse. This is very important when distinguishing the solo feature because there are plans out there for individuals who have full-time employees. This is strictly a plan for individuals who, as I mentioned before, have no full-time employees other than potentially a spouse of the business owner. Solo 401ks were established in 2001 as part of the Economic Growth and Tax Relief Reconciliation Act as a way to give self-employed individuals a way to contribute to retirement plan accounts that had more benefits than a traditional account such as a SEP IRA and included things such as employee deferral or the catch-up provision. There are two types of solo 401ks. There's a custodian-based solo 401k or a self-directed solo 401k. A custodian-based solo 401k is generally going to be established directly through a firm such as Fidelity, and that firm will create the plan documents, create a limited list of available investment options, and may also provide administrative services or other financial services at an additional cost. A self-directed solo 401k, by contrast, is usually set up through a firm such as Vanguard or TD Ameritrade and is self-administered, meaning that it's on that person to set up the adoption agreement, any relevant plan documents, and come up with a list of investment options. Now, because it's self-administered, it usually allows for a wider range of investment options, such as ETFs or alternative assets, such as real estate or precious metals. When thinking about who a solo 401k is going to be right for, it's really going to be right for any self-employed individual or business owner who is looking to maximize their retirement plan contributions. As I mentioned before, it's also only going to be right for someone who has no full-time employees or has employees who work fewer than 1,000 hours a year and are therefore considered part-time employees and would be excluded from participation in the plan. A business owner also has to have the self-employment income and wages for a solo 401k to make sense. Solo 401ks really allow you to maximize the contributions that you make to a plan. So if you have income that is at a lower amount and you wouldn't be able to really maximize that, there may be other solutions that are more appropriate for your situation. A solo 401k also allows flexibility for an individual to elect their own personal employee deferrals, as well as the flexibility to control the employer matching deferrals year to year. So for a business owner looking for the flexibility in terms of business planning as well as retirement planning, a solo 401k can be extremely appealing. A solo 401k also carries additional benefits such as loans or the catch-up contribution that aren't traditionally found in normal small employer plans. These components can be especially advantageous to someone over the age of 50 who is nearing retirement and really wants to maximize their retirement planning contributions. Lastly, a solo 401k plan is really going to be right for anyone that is looking for a simple retirement plan solution. Once a solo 401k is established, there aren't additional testing or annual disclosure rules as common with traditional 401k plans. The only additional requirement someone may be subject to after setting up a solo 401k is that the IRS may require them to file a Form 5500 annually once the plan assets reach $250,000 or more, or once the plan is terminated, then that form has to be filed. When we think about the contribution rules and the limits in terms of contributing to a solo 401k, you really want to think about this from two different perspectives. First, you want to think about it from the employee perspective, and then you want to think about it from the employer perspective. This may seem silly because usually the employee and the employer are one and the same when it comes to solo 401ks. But both of these set of deferrals come with their own set of benefits as well as takeaways when it comes to effectively planning. When it comes to employee contributions, an individual in 2019 can defer to a solo 401k 100% of their earned income up to the annual contribution limit of $19,000. For those individuals over the age of 50, they would also be entitled to participate in the catch-up contribution that would allow them to contribute an additional $6,000 to this plan, bringing their total individual deferral contribution limit to $25,000 for 2019. Now, when we switch gears to employer contributions, employer can make up to a contribution up to 25% of an employee's compensation for the year 2019. These contributions are generally deductible as a business expense, which can be extremely advantageous for business planning and for the business owner when thinking about how much to make for these contributions. The total contributions for the year 2019 can total 100% of earned income or $56,000 for those under the age of 50. As I referenced before, the $6,000 catch-up contribution is available to anyone over the age of 50. So for those individuals, their total contribution limit for employee and employer deferrals for the year 2019 is going to be $62,000. This really allows you to maximize your retirement plan contributions, considering that a SEP IRA, which is similar in nature, has a total contribution limit of $56,000 because it does not include that catch-up contribution. So this is where the solo 401k can really flex its muscle by having things such as that catch-up contribution. In addition to the high contribution limits attributable to a solo 401k, there are some other unique features and characteristics to the plan. An employee can make either traditional or Roth contributions to a solo 401k. What this means is that contributions can either be made on a pre- or post-tax basis. In a traditional account, contributions are made on a pre-tax basis. What this means is that it's going to reduce the individual's current income base in the year for which they're making their contributions. This is going to be a current tax benefit to that individual. Now, later in life, that account is going to have grown tax deferred, but when they go to make withdrawals, those distributions are going to be taxed at their ordinary income tax rates. By contrast, a Roth solo 401k, contributions are made on an after-tax basis, which means the individual does not receive any current tax benefit because you're using after-tax dollars, so your income base is not reduced. However, These contributions still grow tax-deferred just like a traditional account, but unlike a traditional account, any distributions not subject to penalty are done tax-free. In addition, solo 401k plans may allow for hardship withdrawals, but an individual under age 59.5 should be careful when considering something like this, as they may be subject to an additional early withdrawal penalty. Some solo 401k custodians and providers will also allow for loans, meaning that an individual can access a portion of their retirement account balance on a tax-free basis. There may be additional charges to consider for this, however. Lastly, solo 401k plans also allow for rollovers from other retirement plans, such as SEP IRAs, simple IRAs, and government 457 plans. This allows a participant to consolidate and simplify their retirement holdings to make sure they're maximizing their retirement plans and make sure that they're reaching their goals and objectives. When considering the benefits of a solo 401k, or when considering a solo 401k in general, you're going to want to take into consideration not only the benefits, but also the potential drawbacks of the plan. Solo 401ks have a tremendous amount of potential benefits depending on your situation. I've already referenced a few, but when thinking about it in terms of retirement planning, solo 401ks have some of the highest contribution limits available to self-employed individuals. As I mentioned previously, in 2019, an individual can have a maximum amount contributed to their account of $56,000 when considering both employee and employer contributions. When you are over the age of 50, that limit increases from $56,000 all the way up to $62,000. That's really maximizing the amount that you can contribute to a retirement plan. Traditional 401k plans must test plans every year to make sure that contributions made by rank and file employees are proportional to contributions made for managers and owners. This is known as non-discrimination testing. And in most instances, this is going to result in the business owner being categorized as a highly compensated employee. And as a result, they're most likely going to be unable to contribute the maximum to their 401k plan. A solo 401k plan is established by the business owner for their personal benefit or their spouses, which this means that usually it only covers highly compensated employees. So non-discrimination testing does not apply to solo 401ks. This greatly simplifies the administration of solo 401k plans, but really also allows the business owner to maximize their contributions every year, since they would not be subject to these non-discrimination testing rules. Solo 401k plans also allow for flexible contributions. While some defined benefit plans and other qualified plans may require that you make consistent and repeatable contributions, solo 401k contributions are flexible and can be adjusted year to year. In addition, contributions can also be skipped in some years, which is going to allow for additional flexibility and makes the individual 401k plan a very powerful retirement planning and business planning tool. Some solo 401k plans are also easy to establish, and typically most providers will provide you with the necessary documentation in order to establish an account. Basic documents include an adoption agreement, as well as a plan document that review the features and limitations of the plan. There may be some additional forms that need to be sent to the IRS, such as Form 5500, but again, that form does not have to be filed with the IRS until the plan's assets either exceed $250,000 or once the plan is terminated. The IRS may also require that a solo 401k plan has disclosures that are distributed to employees on an annual basis. Although solo 401ks are on an individual basis, disclosure still needs to be provided since they are categorized as qualified retirement plans, similar to traditional 401k plans. Since employer contributions are made on behalf of the employee for the business, these contributions are generally tax deductible to the business. This means that year to year, an employer can deduct a contribution of up to 25% of an employee's compensation when directing those funds to a solo 401k plan. For the participant, there are two potential tax advantages to consider. The first is when they are contributing to a traditional solo 401k. As referenced previously, when contributing to a solo 401k, any contributions to this type of plan will result in the participant's income being reduced dollar for dollar by these amounts and resulting in a lower current income tax base. This provides a current tax benefit to that participant. However, the one thing to consider is when the participant withdraws funds from this account, these distributions will be taxed at the individual's ordinary income tax level. The other tax advantage participants can get is through electing Roth solo 401k contributions. Now, these contributions are made with after-tax dollars, meaning that the participant's income tax base will not be reduced in the current year. However, funds in these accounts will continue to grow tax-deferred, and when they are distributed, as long as they are not subject to any additional penalties, those funds will be distributed tax-free, providing tax relief on the growth of funds within that account. While I've listed a bunch of the potential benefits of solo 401ks, there are also some drawbacks to consider when looking at these plans. One of the things you should always consider when evaluating investments is cost. And cost should always be a factor. And it should always be considered as to what the best solution is for your situation. When it comes to establishing a solo 401k plan, there may be upfront registration and legal costs as well as ongoing administrative support required to monitor the plan. A lot of companies will bundle these services together, and these costs will vary, so it is important to consider when looking at establishing a solo 401k plan and determining the right provider for you. Some providers will also offer additional banking and financial services, such as commercial lending, which may result in additional costs as well. If a company is new and just getting off the ground and not sure as to what direction they're going to go, a solo 401k plan may not be the right option. As mentioned previously, these plans are for individual business owners. Any employer-based contributions to these plans have to be made in a uniform and consistent manner, meaning the same methodology and calculation must be used for all employees. As a result, solo 401k plans can be a potential business limiter and should be avoided if there are intentions to grow the business down the line and bring on more full-time employees. However, if a business only intends to hire part-time employees who will work fewer than 1,000 hours, then a solo 401k may still be an option to consider. Another drawback to consider is that while a self-directed solo 401k plan and self-administration is available, most solo 401k plans tend to have a limited set of investment options because most people tend to select a custodian-based solo 401k plan. As a result, you want to make sure to review the available investment options to you before establishing your plan, because you want to make sure those investment options, if you are moving forward with a custodian, align to your goals and objectives and make sure that they're in line with what your cost expectations are. One final thing to consider is the protection that solo 401k plans provide. While traditional 401k plans, are generally provide full protection from creditors both inside and outside of bankruptcy, solo 401k plans are more complicated. Due to the fact that traditional 401k plans are subject to the rules of ERISA, credit protection is provided inside or outside of bankruptcy. Solo 401k plans, by contrast, are not subject to ERISA. Fortunately, the assets within an individual 401k plan are protected from creditors if you declare bankruptcy. However, outside of bankruptcy court, creditor protection for solo 401k plans is done on a state-to-state basis. So that's when it kind of gets into a little bit of a gray area. Taking everything into account, if you'd like to move forward and establish your solo 401k, there's 6 steps you need to take in order to successfully establish your plan. First, you want to review your eligibility for establishing a plan. This is relatively simple, and as long as you are a self-employed individual business owner, you will most likely qualify to establish a solo 401k plan. Determining if the plan is right for you is a personal decision based on the features and limitations described previously. You will also want to consider other qualified retirement plans to make sure the plan you select fits your specific needs. Next, you want to research potential providers to find a match. You want to review firms that offer administrative service as well as ones that allow for self-directed solo 401ks. You want to compare the various costs, what services are included, what services are not included, and what the investment options are. You'll want to move forward with the firm that offers you the most service for whatever your goals are for the plan. You also want to ensure that the objectives and the mandate of any investment products are conducive to your own values and goals. Now, once you have selected the appropriate provider for your needs, it is now time to establish your plan and start creating your plan documents. As previously mentioned, most providers have a system for this. And if you utilize a custodian, they'll usually have an employer kit that is to be filled out to establish a plan. This will allow the provider to create the adoption agreement and the basic plan document in order to create your solo 401k plan. These documents will review the plan features, investment options, and the costs. Please review these documents thoroughly before moving forward to ensure that everything is outlined appropriately and that any investment options meet your goals and your needs. Once you've decided on a provider and you've established your plan, it's time to provide the disclosures to your employees, usually yourself. This may seem counterintuitive, but it is required because a solo 401k plan is still technically a qualified retirement plan, so these disclosures have to be provided. Additional disclosure needs to be provided that explains details about the plan, where the assets are held, and what the investment options are. Lastly, the employee would need to be informed as to what their rights are, what the timing is around any potential employer contributions, and what eligibility and vesting schedules are to be used. Once all these documents have been created and distributed, you are now ready to open your account and begin funding. And once you've started your account and you've had it established and you've provided proper disclosure, you can now work with your provider to start making contributions. The thing to consider here will be whether you want to make Roth after-tax contributions or pre-tax traditional contributions. You also want to consider who your beneficiary should be, as they will have to be listed on the application at the time of account opening. This can be changed at any time, but in order to establish a retirement account, beneficiaries have to be named. Lastly, once your account has been established and is now active, you are ready to start funding your solo 401k account. All employee elective deferrals should be calculated and made as of 12/31 of the year that they're to be captured. Employer contributions, however, can be made up until the employer's tax filing deadline, including any extensions. Contributions, again, do not have to be made on a regular basis. It can be made on whatever basis is feasible for the participants. For the participant, contributions can be weekly, monthly, quarterly, or annually. For the employee, they just have to be made prior to 12/31 and the year they're to be recorded. In addition, contributions can be skipped and do not have to be regular ongoing contributions. That's going to wrap it up from my side. So I'm going to turn it back over to Amanda to see if there are any questions out there and what I can answer for people.
Hey, Andrew, thank you so much. So we do have a couple questions that I'm going to get started with here in just a second, but just as a reminder, you can use the questions portion of your GoTo webinar taskbar there to submit your questions, and if we do have time to get to those today, we will. So it looks like the first one we have here, Andrew, is do you know what the contribution limits will be for 2020?
That's a good question. And yes, I do. The IRS recently provided an update as to what those new contribution limits will be for 2020. The individual contribution limit is actually going to increase $500 for those individuals under the age of 50 to bring that to $19,500 for 2020. And then for an individual over the age of 50, the catch-up contribution is actually going to increase as well to $6,500, meaning that they can contribute a maximum of $26,000 in 2020.
Looks like the next one I have here is, can I roll over my simple IRA to a solo 401k?
Yep, another good one. And as I mentioned before, one of the advantages of the solo 401k is that it's a qualified retirement plan. So it does allow somebody to really consolidate and really put all of their holdings into one place so that they can efficiently plan for their financial future. So a simple IRA would be able to be rolled over into a solo 401k.
Andrew, this one says, I am 40 and my business earned $100,000 in 2019. How much can I contribute to an account like a solo 401k?
Okay. All right. So when thinking about that, so if the individual is 40 and in 2019, if you earned $100,000, so you're always able to contribute up to 100% of your income up to that limit of $19,000. So for the employee side of the contributions, that person could contribute a maximum of $19,000 to their account by December 31st of this year. In addition, there's also the employer side of the contributions. So that employer can make a matching contribution of up to 25% of that employee's contribution. So in this scenario, the maximum contribution that somebody could make would be $44,000 in the year 2019.
Awesome. Thank you so much for that, Andrew. I am going to, just in the essence of time, I know we were just trying to keep this as a quick webinar here to end it with the holidays coming. And just as a reminder, we will be working on getting a white paper up on our website soon, probably in the next week or so, if you'd like to take a more in-depth look at this topic in particular. And we are continuing in January with our next webinar, which will be with our Chief Investment Officer, Chris Gauthier. He'll be going ahead and continuing with his CIO's Corner, and that's January 24th at 12 p.m. You can sign up for that directly on our website as well. And Andrew, thank you so much again for joining us, and we hope everyone has a wonderful holiday, and we will talk to you in the new year. Thank you so much.
Thank you.